to this.
Okay.
Hey, guys.
Hi, Jim.
How are you?
Good. How are you?
I'm good.
That's
Hi, Jim.
great.
Hey, Maura, we can't see you.
Oh, well, that's a shame. There I am.
Yay.
Here we go. How's it going?
Going well.
Good. All right, awesome. I have got to get on one website and then I'll pay lots of attention. Hold on.
Yeah,
See.
we gotta find our.
That's-
Mike, you have the same presentation you sent me. Is that the one?
Almost completely. I've tweaked it just a little here and there, but yes.
Okay.
Okay. I'm good to go. I'm good to go.
Been a while since I had to do one of these, Maura.
Well, you know, it's time to dust off your skills, isn't it?
That's right. If I can remember anything about the furniture business.
Well, you're an old man now, you know. So we're going to be on hold for about maybe 5 to 7 more minutes. So just be patient with us. At this point, we have 10 schools signed up with an unknown number of teams. Last year, we had 7 schools and 10 teams made it to the orals. So our program is expected to be bigger this year. So we'll see what happens.
Great. And more, we might, once we kick off, I'll just share my presentation and walk through that, correct?
Correct.
Okay.
So I will kick off. I have a few administrative items that I need to get through. I'll make a brief company introduction that will pale in comparison to the one that you're about to give. And then just wrap up with kind of how we'll do this procedurally. After your presentation, obviously you and Jim will share the presentation, and then we'll ask the schools to go around and ask one question a piece. Sometimes they do, sometimes they choose not to. And then Deb and I we have our own list of questions just in case there's a lull. This is a recorded call. So much like your own earnings call, we allow the schools that might be late to the sign up to look at this call to catch up. A lot of our schools are on the quarter system. You may remember, Jim, from Northwestern, how late in the season that would be. So for our quarter system schools, we record it just to allow them to catch up.
Great.
And we're good on time, so don't worry. You know, if there's questions, we can take
Thank
as
you.
much time as needed.
Thank you very much. We expect that this will be about a 90-minute call at most. So I've got my water. See, you know, I'm ready. So good. At this point, we have 21 participants, 22, and we probably will get up to about 50. So thank you so much, Mike and Jim, for spending the time with us. We
It's fine,
recognize.
it's fine.
Okay, we're getting some feedback. Okay,
Yeah, we're glad to do it, Maura.
we appreciate it, Jim, very much. This is our first non-Chicago company, so we're very excited.
You didn't go very far from Chicago.
No, we didn't go very far, but we wanted to choose a company that had a specific emphasis on ESG, which is a relatively new category in our exam. So that's one of the reasons that we went outside our city boundaries and certainly our state boundaries. Okay, what are we up to? 26. Okay, we're almost ready to go.
No, we don't have actually any questions on ESG.
Be careful, students, to mute your microphones because we can hear everything you say. Just a few more minutes before we kick off. I'm going to get ready for my new career as a newscaster. Okay, it is 1:01. Let's wait one more minute, please. We have 32 participants, but we know that we have a couple of boxes in our Zoom call where there are multiple participants. So we know our count is higher than that. Jim and Mike, just so you know, this is an anonymous contest. And this year we have been very creative and have called our teams various colors. So you'll hear us call out to team yellow, woo, and green and blue and various colors. So you're not going to know the actual universities. Okay, now how are we doing? 33, okay. All right. All right, well, I think we're good to go. We have 35 participants in our Zoom call, and we're hopeful that we'll gain a few more as the time goes on, but it is 1:02 and we'd like to start on time. First of all, I'd like to introduce my colleague, Deb Cook, my partner in crime. Hi, Deb, how are you? Deb is a senior vice president and senior technology analyst at Northern Trust. She has been a CFA. We have known each other since, oh my gosh, the mid-90s. And we have been co-leading this contest for the past 12 years. At this moment, I'd really like to remember our third colleague in crime, Larry Lannis, who passed away this summer and who built so much of the foundation of this contest. It wouldn't be right not to remember him, not to shout out to him wherever he is. A few administrative items. Number one, students, please grab a pencil and a paper. I'm going to give you a phone number. If you have a technical problem, please call the CFA Chicago office, ask for help. Area code 312-251-1301. Professors, I'd ask you to pay attention to this change. We've had an overwhelming interest in our program this year. In the past, our program has been smaller, and Deb and I have done our very best to allow as many teams to proceed from the writtens to the orals as possible. This may not be possible this year. This year, there is no assumed pass from the writtens to the orals. This is a difference in how we've been operating for the past roughly 5 years. You will all be considered participants in the research challenge, but not all of you will be eligible to be finalists. We will use the written report scores to provide the basis for an elimination round. We only have so many volunteer graders and so many volunteer judges, and that is something that we are facing this year as our program has expanded. I can't say at this point how many teams will make it. Last year we had 10 participants in the orals. I think that will be less in the coming year. We don't know how many teams have actually registered. We'll know that on October 21st, but that's something you should expect. We're trying to read the tea leaves as best we can, so heads up. You may get a notice to say that your team has advanced to the orals. You may get a notice to say that your team has not advanced to the orals. Another administrative point that I'd like to make very clear, as our students here are not all registered and are still considering participation in our contest. One school asked about the minimal expected time commitment. This is the opposite of a typical college paper. I thought when I was in college that I was really working very hard to spend about 10 hours on my college paper and that I was going to get an A. This is a contest that requires about 100 plus hours of commitment per student. I would say that our winning global team from Chicago last year spent more than double that amount of time individually. So as you're moving forward, I would ask you to consider that type of commitment that you have alongside your normal academic work. Another additional administrative comment is that this year we will be very strict about not accepting papers with a font that is smaller than type number 9. We had a few schools who submitted papers with font sizes smaller than that, and our graders were asking for magnifying glasses, including me. I wear bifocals. It was hard. Finally, I would like to point out that our next scheduled Zoom call is November 4th at 1 p.m. We are having a well-renowned professor, Jim Valentine, CFA, who has been a professor at DePaul, who has done a lot of work on the topic of valuation. As you know, valuation is 20% of your paper score. So we thought this year we'd bring Jim in to talk about the various methodologies of valuation that have made these papers outstanding. So we're trying to raise the bar on that particular section. Moment, hold on. I'd like to introduce Mike O'Mara. Hello, Mike.
Hello, everyone.
Hello, you are the Director of Investor Relations and a key member of the financial team at Steelcase, located in Grand Rapids, Michigan. And I'd like to welcome James Keene, who goes by Jim. Hi, Jim.
Hello.
Jim is the recently retired chairman of Steelcase. Steelcase is a manufacturer of integrated furniture settings for the workplace. They are user-centered technologies and interior architectural products. The company designs furniture for office settings, including adjustable desks, benches, tables, storage products, ergonomic chairs, which I desperately need, collaborative seating systems, cubes, etc. The brands you'll see as you do your research include Steelcase, Coalesce, Smith System, AMQ, Turnstone, Designtex, and Polyvision. The company is an old company. It's 110 years old. It was founded in Grand Rapids, Michigan. This is our first company from outside the Illinois area. We chose this company because it is small cap, and small cap companies present their own challenges in analysis. The company became a publicly traded company in 1998. It has 12,000 employees and has about $3 billion in revenue. One of the focuses of our research challenge has been the brand new category of ESG, environmental, social, and governance topics. It's really difficult for us as outsiders to judge how well a company is doing in ESG, right? We don't necessarily teach this topic in schools, just like valuation is maybe taught. So ESG is something new to many of us. And this is important because it accounts for 15% of the written point total. Steelcase has done a very good job of bringing ESG up to the board level and embracing it. So we have a lot to learn from Steelcase in that regard. So at this point, before I turn it over to Mike and Jim, I will let you know procedurally, after the company presentation, Deb Cook will take over. Are you ready? Oh, good. And we would like to make sure that you keep on mute until we call on you. You'll ask a question, maybe it's Team Blue, and Team Blue will ask their question and then remute immediately so we can keep control over the sound quality. So with that, Mike O'Mara, I'm going to turn it over to you, and we appreciate your time and patience with us today. Thank you so much.
Absolutely. And thank you, Maura and Deb, for inviting this. On behalf of Jim and I, we appreciate the interest. And actually, we're very much looking forward to the feedback and the questions and all the work about to be undertaken. I'm going to go ahead and share. I assume that's coming through, if I've learned how to use Zoom by now.
Yes.
All right. So we're going to do our presentation today. This is our normal investor presentation. I do this presentation all the time with different investment audiences. I'm actually going to be in Chicago Monday morning, meeting with different groups of investors. Now, typically, if Jim and I were doing this presentation together when he was the CEO, he would probably do a little bit more of it. Today, because he's actually not active in the company, I'm probably going to do a little bit more of the presentation than normal, but Jim's also going to participate where he wants to, and he's very available for Q&A. So just a little bit about us. So I've been in my role for 6 years. I lead investor relations and financial planning and analysis. Before this role, I led our pricing and contracts team in the sales organization, working with our sales teams, our dealers, and our customers to set the terms under which we're going to do business. And I also held various other finance roles over my career in different product categories. So prior to joining Steelcase in 2000, I worked at Quaker Oats right there in Chicago. It's now part of Pepsi, but at the time it was independent. And I began my career with Arthur Andersen, which was a public accounting firm at one point in time. I received my undergrad from Michigan State and my MBA from Northwestern. Just speaking for Jim real quickly. So Jim was the CEO. He announced his retirement last year. So he was our CEO for 8 years and served on our board of directors. Currently, Jim is the chair of the audit committee at Rockwell Automation, and very importantly, he continues to be a Steelcase shareholder. Before the CEO role, Jim held a variety of different roles for about 2 decades at Steelcase. He was our chief operating officer, he was our president of our Steelcase group, and he was the CFO. During that time, Jim presided for over more than 30 analyst calls, and he met
And
regularly.
Mike, I realize it's actually like 60 because I did 30 as CEO and then probably 30 more as CFO.
Oh,
So,
okay.
and just to put that in perspective, like when we think about meeting with analysts, there's 3 or 4 different formats. One is the quarterly analyst call, so quarterly earnings, and then the analyst call that follows that with a lot of Q&A from analysts, and that's 4 times a year, obviously. Then we do these kinds of presentations that Mike does all the time, but the CEO would probably only do maybe 3 or 4 of those a year. And then we have visits where analysts or investors will come to our headquarters for a day, sometimes alone, sometimes in a group, and those are more kind of bespoke. So Mike and I have done quite a few of these together in all those different forms.
Thanks, Jim. Yep. Before joining Steelcase, Jim worked at McKinsey and Motorola. He received his undergrad from the University of Illinois and his MBA from Northwestern, so go Wildcats. And very importantly, Jim was born and raised in the Chicago area. So you can see the Chicago connections kind of coming through, which is part of the reason I think we're both excited to be participating in this. Just real quick, little thing that always happens, safe harbor discussion. So we're going to use some forward-looking statements potentially from time to time today. Those change all the time, of course. So just use anything that we say today with caution and the fact that things could change, and we're under no obligation to update you as things change. So our investment thesis, again, this is kind of the way we see the investment thesis in Steelcase. First of all, we believe the office will continue to be very relevant for innovation, culture, and collaboration. This is a very interesting time, I think, for you to be considering Steelcase, given what's going on in the ways of that we attend work. But we believe it's going to be very relevant, and we'll talk about that more. In an changing workplace environment, as an industry leader, we believe that provides growth opportunities. Every time a customer has a need to consider changing the workplace, that's good for us. It means that it's potentially a furniture buying opportunity. And with everything going on with the way we're working today and the ways those may change, that's a positive opportunity for us. Steelcase has
I'll add to that. So, and I'll often do color on this, but the worst thing that can happen to us is things don't change. Our furniture lasts forever. Our biggest competitor is our own furniture not wearing out. So we like change. Sometimes people who are new to our industry will say, well, the move from one kind of cubicle to bench or to shared workspaces or to hybrid work, isn't that a threat to you? And in reality, it's not, because every time it changes, people have to get rid of what they have and they have to buy something new.
Yep. Excellent. Yep. Steelcase has an experienced management team. Many of our executives have been with the company for over a decade. A lot of our executives were managing the company during the financial crisis. And so we feel confident that we know how to work through trying times and cycles. And then the last one is we've been experiencing significant price cost headwinds, meaning inflation over the last 18 months. We expect those to become tailwinds now. I'll talk about pricing in our industry a little bit later, but as that pressure of inflation, we're starting to overcome that with implementing pricing to our customers. So we expect that to be a gross margin tailwind as we move forward. Just a little summary on Steelcase. We consider ourselves a respected leader. We have strong global market share. Last fiscal year 2022, we had $2.8 billion in revenue, as Maura said. Compare that to pre-pandemic, we did $3.7 billion. So obviously the impacts of the pandemic have been fairly significant on our business. EBITDA of $126 million. Our net debt to adjusted EBITDA, which is an important ratio that people watch, is a little under 1 times, which we're happy with. Around 12,000 employees. We serve our customers through about 800 Steelcase dealer locations. And we're recognized for innovative design, sustainability, and civic engagement. Some of those which we kind of note with some of the awards and recognitions. And you can see one that I've highlighted in yellow for this group today, which is we were included in the Forbes 2022 list of best employers for new graduates. And I just thought that might be of somewhat interest to this group today. So Steelcase, our winning aspiration, it's actually quite simple. We help people do their best work by creating places that work better. That's our focus in the world. And we're very focused and concentrated on that. We serve what we consider leading organizations. Leading organizations frequently are companies that are near the top in their industry. They're usually innovatively differentiated in some way. They're not usually a low cost strategy. They're usually trying to do something different. Frequently, that means that they care a lot about their employees and their people. And lots of times that translates to caring about workspace. They understand the connection between place and people. Lots of times they're large, and frequently they'll also be global, which will feed into some of our strategy.
And therefore they're tough to serve. So they're progressive. They're always demanding something new and different. And we picked this for two reasons. One, we think we're the best in the industry at being ready to serve them because we try to be ahead. But secondly, if we serve customers that are leading, customers that are naturally progressive, they will demand more from us than anyone else will demand, and it will keep us ahead. So, as we choose to innovate, if you make the choice to innovate, you also have to choose to serve customers that will value innovation. And that's what that's all about. What it doesn't mean is large necessarily. Sometimes it's large. It doesn't have to be the largest company. Sometimes the largest companies are the slowest to move forward. It's not that we won't serve them, but that's not what we're focused on.
Great. On the right-hand side, you can see one way that we break our business up, and that's our revenue mix by vertical market. We lump corporate and other. That could be government. It could be manufacturing. It could be retail. It could be IT, professional services. Lots of different types of companies that would fall into that. But we do highlight education and healthcare. They're a little bit different in the way that we serve them. So we highlight them a little bit differently. And then you can see that the way that we serve them through the brands, some of which Maura had highlighted that. So the way we break our business up again is by geography. So you can see about 70% of our business is in the Americas. This is revenue. A little over 20% is in EMEA. And then the other category, the largest portion of that is our Asia Pacific business, is about 10%. So again, you can see we are a global company, and we have a fairly significant portion of our business outside of the Americas. As we look at ourselves across some of our peers, you can see Steelcase and Miller-Knoll within the office furniture business are about the same size. Miller-Knoll is a combination of two of our peers that happened about a year ago. Those businesses also have a retail component that's makes them on a combined basis a little bit larger than us, but that's really quite a bit of a different business than what we're focused on. So our customers look at our scale kind of related to the office furniture business. You can see we have two other large North America-based companies, Hayworth and H&I, that are about 50% smaller than us.
I'll just add to this chart that even though EMEA looks smaller at 22%, we are the market leader in EMEA. It's just a smaller market. So it's a smaller percentage of our pie, but we're the market leader in EMEA. And we're probably the market leader or among the top 2 or 3 in Asia. It's just harder to get the accurate data to know exactly the size of everyone in our segment of the market. But so that's why we're the global leader. We kind of lead in every geography.
Yep. And to add to that, EMEA and Asia Pacific are much more fragmented. There's a little bit more, there's definitely more concentration in the Americas, where the top 5 or so manufacturers will make up 50% of the market share. In the Americas, it's much more fragmented in other parts of the world. So on a global basis, one of the ways that we serve those global customers is by having local presence. So we talked about 800 Steelcase dealer locations. About half of those are in the Americas, and the other half are outside of the Americas. We have 65 locations in 17 countries. This is where we actually have Steelcase people, employees of Steelcase. Lots of times those will be in sales offices, but they could also be in manufacturing locations, of which we have 15 major manufacturing locations, and about half of those are in the Americas and half are outside of the Americas. So global is one way that you can think about Steelcase as maybe a differentiator versus some other parts of our industry. Another one is the way we approach our innovation. And at Steelcase, our innovation always starts with research. And we come at that from kind of two ways. We have primary research where we have our own Steelcase employees doing their own studies and developing their own research, but we also collaborate with what we call research partners. So these are organizations focused on something that they're studying deeply, and we collaborate with them. And through that combination, we develop what we call insights on work. Those insights, of course, feed our product development process towards the chairs and tables and desks that we develop, and that's a very important part. Steelcase believes our products should be beautiful, and of course, they should be durable and affordably priced. But they have to do something. They have to be solving some kind of problem that we've identified in the workplace. And Steelcase products will always start with that kind of goal. The other part of our research, the benefit, is that we become a resource for our clients. We have a goal to become a trusted advisor of our clients, and our ability to translate what's happening in the world to giving them advice on how they should develop their workplace becomes a key part of our differentiation. We do that locally in our showrooms, but we also bring customers to Grand Rapids and meet with some of our specialists to really go deep and understand factors impacting the workplace. Before I jump a little bit more into our research, I did want to take one step up and talk about some of the macro factors that we focus on. And obviously a lot of people that we talk to in the investment community, of course, focus on these factors. So there's 6 that I want to highlight that we focus on in the United States. So the first one is corporate profits after tax. Obviously, companies need money to fuel their investments. When they're making money, they have more of an ability to invest in their business. And that's kind of one of the categories that we fall in to. You can see kind of during the pandemic time frame, corporate profits had taken a hit. It's been a fairly robust corporate profit environment for the last few 6 quarters or so. A little bit of pressure right now on the world of corporate profits, so that's why we're calling this overall mixed, but still healthy, just not quite as healthy as it was a few quarters ago. Unemployment is something we track. Typically, low unemployment is good for us at Steelcase. It means there's lots of workers at companies. It also can mean there's competition for talent. And when there's competition for talent, that's good for us. Workspace is one way that companies differentiate versus just salaries and benefits and job content. The flip side of low unemployment right now is, and it's kind of a new factor, the power shift between employer-employee around returning to the office right now is an interesting dynamic that's playing out. And because of low unemployment, it's putting a little bit more of the power shift in the employee's hand. You may have read articles where companies are asking their employees to come back to the office. And sometimes they're successful with that, and sometimes they're getting more resistance from their employees. And because of this low unemployment environment, companies are having trouble deciding how hard to push their employees to come back to work. And we'll talk a little bit more about why companies want their employees to come back to work, but that's kind of 2 sides of this unemployment story. CEO confidence. Typically, if CEOs are confident in their business, they'll invest more in their business. When they become less confident, they get a little more cautious and have to pull back. And not surprising, probably to anyone, this has been under pressure as of late. As you can see, the confidence numbers have dipped below 50, which is seen as a mark of confidence. We fall under the category of non-residential fixed investment. It's been fairly healthy for the last several quarters. Maybe there'll be some pressure coming in the future, but so far it's been fairly healthy. Architects are an influencer in our business. If architects are busy designing spaces and buildings, typically that's a good sign for us. It's been a healthy environment. It's been under a little bit of pressure more recently, but it's been fairly healthy. And then real estate absorption. If office space is getting absorbed, meaning leased, that's typically good for us. You can see during the pandemic quarters that obviously was under a lot of pressure. More recently, we've started to absorb some of that real estate again. So those are
Although on that one, I'd say that a lot of times we get asked that question because people who cover the real estate industry know that's a really important metric. It's a little less important for us. In fact, you could argue that at times when there's a lot of real estate available, it's easier for our clients to find space to lease. And therefore, it triggers more demand for us than when real estate is kind of tied up. The one on this page that we always talked about was non-residential fixed investment. That of all of these, that's That's the ring that governs them all, it seems. Like when that's strong, then we usually get a bit of that. Although usually not at the beginning of a recovery cycle, it's usually towards the end of the recovery cycle. Spending in non-residential fix starts to shift over to things like furniture.
We don't have as many data points in Europe, but because it is 20% of our business, obviously we make sure we highlight what we're looking at for the investment community. GDP is kind of the simplest way for us to think about it. We look at other metrics, but we highlight GDP. Germany, France, and the UK are our largest 3 markets. And so that's why we show those. Again, it's been a fairly good environment in Europe for a lot of people, surprisingly robust as far as is held up pretty well. There's of course a lot of concerns about the environment moving forward, but thus far it's been fairly supportive, and our business has done okay in EMEA. So going a little bit more into research, because it is an important part of understanding Steelcase. Obviously, the big story over the last 2 years has been this concept of hybrid work. This is the idea of sometimes working in the office, sometimes not working in the office. In this mixed presence of some of our people are in the office, and while some are not in the office on a day-to-day basis, is sort of the new factor impacting a lot of what we're studying. So we like we always do, we focus some of our research on the most important topics. So this was a topic that received a lot more of our research. So you can see we studied 57,000 workers. We broke that up across 12 what we call primary studies of different influences and factors, and it was around 11 countries. So again, we were trying to be very broad in our approach. And the 3 key findings that we're highlighting for people, the first one is people who like working in their office are more engaged, they're more productive, and they're more connected to their culture. And what that leads to is they're more likely to stay. That we find a lot of our company leaders, it makes sense. They understand that. They're trying to figure out how to do it. But we were definitely able to validate that, yes, this is happening.
One data point on that is work that was done by Gallup over a long period of time that showed that the #1 reason people chose not to leave their employer was that they had a best friend at work. That always made CEOs uncomfortable because you didn't like asking that question and you didn't know what to do about it. But it was true nonetheless. If you had a best friend at work, you were more likely to stay where you work. One question is people who have been hired in a virtual world and have worked in a virtual world over the last couple of years exclusively are probably less likely to have made a virtual friend. You know, friendships are just more likely to be made in person. And so that's one of the things we're talking with folks about and aware of. Or as time goes by here and we have fewer friendships between colleagues in an office, might you see higher turnover? Yes, it's easier for you to hire people anywhere through remote work, but it's also easier for your people to be hired to leave and go to some other company if they don't have these the stickiness of friendships.
Yep, great. The second finding that we highlight for people is that people are willing to trade remote days working not in the office for their own workspace. So we had been moving for many, many years towards denser packed, more density in the workplace and more sharing, meaning you didn't always have your own workstation because you weren't at your desk as much as we used to be. What people are saying is, if you give me my own space, I'm more likely to come in the office. As we all went home kind of during COVID and quarantine, one of the things we liked was the comfort that we had, the control that we had over our space, and the fact that it was our space and we weren't sharing as much as we had been pre-pandemic. So that's something that employees are telling employers, if I would come in the office more often if I had my own space. And related to that is this access to privacy. It doesn't mean you need your own office all the time, but when you need to focus and when you need privacy, it needs to be available to you. And it's a very important part of workspace design, is how much privacy you make accessible to your employees as you lay out your floor plan.
I'll add on this that the experiences people had during COVID were quite different depending on what their status was within their organization. So middle managers, vice presidents, CEOs have bigger houses and they have spare bedrooms or they have dedicated offices that they can work in. And so they got a lot of privacy. And for them, coming back to a crowded, dense office isn't the best thing. So that's exactly what Mike was just saying. At the other end of the spectrum are people who are earlier in their career, who aren't making a lot of money. Maybe they've got a roommate They probably have a small studio apartment. They might even be living at home, which a lot of people were during COVID. Trying to work in the laundry room, trying to work on the dining room table. We got photographs from all over showing the kinds of environments people were working in, and for those folks, it wasn't great. So they're coming from a different work at home environment than the executives.
Yep. Everyone wants privacy though, available when they need it. And that's a big, that was true before the pandemic, but it's also even more true now as we all got used to a little more privacy. Just a couple statistics on this liking your office matters that we like because we think it's meaningful. It's not just, a little bit better. Our research showed that people that liked their office were 33% more engaged. They were 30% more connected to their culture. They were actually 20% more productive. Again, this is if you like your office, and they were 9% less likely to leave the company. So we were able to come up with these proof points and these statistics, and we think it helps decision-making within companies as they try to quantify the benefits of some of their investments in the workplace. So some other things that we learned, and it helps influence our designers and the way we lay out space, is this 5 things that we showed people need in this idea of a hybrid workplace. The first one is belonging. Everyone's looking for this sense of community, trust, and sort of the shared purpose. And we know that when you get people together, they're more likely to form this sense of trust and community. It's very, very difficult to, of course, do that over a fully virtual environment. Control. So people want more choice and control over where and how they work. That's not new for Steelcase, but it was new for a lot of companies. A lot of companies were very much living in a world of you were expected to be in your office, in your desk, in your chair, and the manager having line of sight to you was kind of a factor. People don't want that as much. They want to have some flexibility. We called it choice and control before the pandemic. And it's essentially the concept of flexibility. Productivity. So this is the idea of trying to be productive, whether you're in the office or whether you're at home. And when we have mixed presence, meaning some are in the office and some are at home, can we still maintain our level of productivity? Because that factors into the choice and control that you can allow people to have. Comfort. People want spaces where they can rejuvenate. They don't want a sterile environment that isn't motivating, that doesn't energize them. And they want to be supported of their well-being, meaning things like ergonomics. Chairs have always been pretty well focused on the ergonomic environment. Height adjustable desks are becoming much more standard, more casual environments in the office to help with some of this level of comfort. Some of the things we love from the home have continued to find their way into the office. Again, this more casual environment. And then of course, safety. This ebbs and flows a little bit through the pandemic surges and viruses, but people need to, of course, feel safe physically and psychologically as they come in to work. So some of the shifts that we're seeing and that we expect to continue is this shift from coming to the office mandatory to the shift in strategy of making your office attract people. Some companies are trying the mandatory part and you'll get some level of compliance for that. We're finding customers that go for the, competing for the commute, make the commute worth it, is actually having a lot of success if their office actually attracts people where they see that's my best place to work. Historically, the office was designed for some level of permanence, meaning stability and longevity. We think it needs to be designed to evolve. It needs to be able to change. Sometimes that's at the hands of the actual employees, but sometimes that just means more consistent retrofits to adjust for the new needs of the office. In the past, it was predominantly open. We need access to privacy moving forward. And in the past, we were a little more homogeneous in the way we would lay out an office. We need more diversity, which would allow more people to feel comfortable and find their best place of working, meaning one size doesn't fit all, but it should also be inspiring. And we use a word of joyful. And then go ahead, Jim.
I was going to say, this is the reason we're going through these pages. Like, I think this is a really important section because it's fundamentally the question of whether you believe the investment thesis. So if you're an investor in Steelcase, I think you believe 2 things. You believe, first of all, that people are still going to work at offices. Yes, we have a healthcare business, we have education businesses, we serve, a broad range of folks. We compete all over the world. But if you believe people aren't coming back to offices, then an office furniture company is not going to be a great investment, right? So you got to believe that, first of all. Offices will matter for all the reasons we said, not because of old-fashioned ideas about people just have to do it, but because it builds better collaboration, better innovation, better connections between people, less turnover, all those. That's a thin layer of intangibles that can create competitive advantage. You got to believe that part. The second thing you believe, if you believe the first part, then you go, well, if I believe the first part, and if people are going to come back to the offices they have, that's fine, I guess, but it's not like a growth model. But if you believe the offices they have are not going to work anymore, then you've got two parts of the story. You've got, yes, they're going to come back to offices, and their offices that they left are not going to do it. They need different offices. So offices that really work as attractants, offices that really provide privacy, offices that really designed around collaboration. If you get both of those, then we get that engine going that is going to drive growth for someone in our industry. And I guess the third point is, do you think Steelcase is best positioned to do that? We think we are, but that's the fundamental investment thesis.
No, thanks, Jim, for highlighting, why we go through this with the investment community, because they're not experts. They don't study work like the way we do. And this is our point of view. And that actually leads us to our strategic priorities. So we, of course, have choices we need to make about what we think is going to matter. And so we've laid out 4 strategic priorities, and I'll walk us through those. So the first one is, we've said we need to lead the hybrid work transformation. By that, we mean we need to be the most trusted partner in hybrid work. I talked about the research earlier and why we do that and how we translate that to our customer base. We need to lead in innovation to support hybrid work. So that means creating new things to support new issues. So this is what feeds our product development. We need to deliver a seamless experiences by integrating technology in place. So we have partnerships with Microsoft and Zoom and Logitech. Those partnerships are based on needing to understand how technology in place come together to design a good experience when you walk into a room, a good technology experience, because there's no meetings that don't have technology anymore. And the more problems we have with how that technology integrates with the place, it actually impacts the performance of the meetings. And then the home office. So Steelcase is focused on the home, or has served the home office for many years, but it really wasn't as much of a focus. It was more of a courtesy that we made our products available, which typically were being sold to employees of our customers. As the working from the home has become more important, we've also dialed up our effort on creating solutions for the home office. So our second strategy we focus on is deepening our presence in what we call key growth adjacencies. So these aren't new to Steelcase. We just think we need to deepen our presence here, somewhat because the first one is under a little bit of pressure, our key core historical market. But we also think these are areas that there's actually more growth available to us. So the first one is, we think we're uniquely positioned to grow more strongly in EMEA and APAC. We had been focused on that. We continue to see that opportunity. Steelcase Learning. So Steelcase has historically had good market share in higher education. We saw an opportunity to expand in the K through 12 environment as some of the learning behaviors and practices were moving down from higher education to K through 12. So think of the use of technology in collaboration and mobility in the classroom. As we saw those moving to K through 12, we saw an opportunity for Steelcase's value proposition. We made an acquisition of a company called Smith System a few years ago, and we are continuing to focus on leveraging those learning, those capabilities into our broader learning opportunities. Digital to create compelling customer experience. So this is something that we were forced to figure out better during the pandemic. We had to figure out how to show furniture to companies when they weren't able to travel. And so we've found unique opportunities to increase our digital experience, which can actually go beyond the in-person experience in some cases. And then lastly, there's a customer set that's focused on speed and simplicity. So they of course love our research and they love our global presence, but some customers don't want all that. That's more complexity than they want, and sometimes it takes longer for them to understand on that kind of than whatever their timeline is. And so we're ramping up our focus on winning with speed and simplicity. Typically, that means serving smaller customers. So speaking of ESG, or sustainability, or using your business as a force for good. That's essentially our third strategy. And I know Jim will have a few things to say on this, but this is not new to Steelcase. We didn't start talking about ESG when the rest of the world started realizing how important that was. Sustainability, caring for the environment, treating each other with dignity and respect. That's been part of Steelcase for a long time. It's actually one of the main reasons we went public over 20 years ago is some of our founding family members wanted to unlock their capital to give it away for philanthropic reasons to help improve the environment. And maybe before I dive into each of these strategies, Jim, do you want to say anything else kind of in your perspective?
Yeah, maybe should I just talk about ESG now, Mike?
I think so.
So, yeah, as I said earlier, environmental, social, and governance is what we're talking about. And I'm going to pull DEI, diversity, equity, and inclusion, into this because they go together. So under the E of environmental, it's the topics that we talked about. Actually, if you flip forward one page, I think, Mike, you've got planet, people, and culture.
Yep.
This is one of the ways we think about ESG inside Steelcase. When it comes to environmental, since my first board meeting 25 years ago, where a board member would ask me about ecology. That's what they all called it before we had environmental. They called it ecological decision-making. So they would ask about every decision we made and how do we think it affects the environment? And in those days, that was so rare and so frankly kind of weird that it stood out. But you get asked that question a couple of times in a board meeting, and you get used to coming in ready to answer it next time. And that's what every company I think is starting to do now, certainly at Steelcase. So for us, our thinking about environmental issues has become far more sophisticated. It starts with the products we make. Of course, we know that our products are made of things that end up in landfills. So we want to, first of all, have products that last. They stay in the conditions supporting the work they do for as long as possible. So good quality is actually a pretty good sustainability thing. Our products last 20 years, 25 years. We have people still using products they bought 30, 40 years ago. And these days, when we make those products, we try to use as many recycled materials as we can. And then we also design our products so they can be taken apart at the end of their life and separated into the various waste streams. The Think Chair, which is one of our top selling chairs designed many years ago, was designed just for that. Like household tools could be used to take this chair apart. So it could actually be recycled. It wasn't just theoretically recycled. So that's how we design products, how we engineer products, how we select materials to go into our products. We also think about the chemistry that goes into those materials. Materials chemistry ends up being a really important topic here. It gets really detailed and technical in a hurry, but making sure that your materials, the cloth we use, the foams we use, don't have chemicals in them that are going to end up in the water stream, because some of those chemicals could last for 1,000 years. And so it's not just whether it ends up in a landfill, but when it ends up in a landfill, will it turn into something hazardous for human health in the future? So we're aware today, down to parts per million, of which chemicals are in our products. We know which of those chemicals are considered to be red or bad for human health, and we work diligently to avoid it. And we hold ourselves accountable by having our products rated by outside companies who acknowledge. We even help set the standard that the industry now uses called Level. So BIFMA is the industry organization, and they have a standard called Level that we help develop that everybody in the industry can use based on the things we learned from our journey. And then the last piece of environmental for now is energy. So as of several years ago, 100% of our electricity was from renewable sources, whether it was wind or solar or others. Today, we're net zero carbon footprint, but we're working to be better still, because we get to net zero by sometimes buying credits to offset the use of carbon. What we want to do as we move forward is to reduce our gross carbon usage so that we can also reduce the amount of credits that we buy. That'll help save us money. And so the money we save on buying credits will help fund the investments we have to make to reduce carbon itself. I'd be happy to talk more about that in Q&A. The social part of ESG has to do with people, right? Social is people, starting with our people. And this is where diversity, equity, and inclusion comes in. We win lots of awards, are recognized for lots of things, areas where we've had progress, including being a great place for women to work. I think we were rated in the top 10 of all companies recently on that front. Half our board or more maybe now are women. We weren't doing that on purpose, but as we became more diverse on our board, the women on our board knew other women who'd be great board members. And so the recommendations when it came time to replace a board member just would move in that direction. So now we have a 50-50 board. We also have a lot of focus on racial diversity, board level, management level, employee level, starting at as the way we hire new people. So our internship program, when we have an internship program for people who are in the Grand Rapids area, we really focus on diversity as being a super important factor. And as we've had a more diverse internship program, we've hired more diverse workers. And so we continue to make progress there. We have a ways to go to be where we want to be. But at least on the representation front, we made progress. DEI is not just representation, though. It's also about inclusion and making sure everyone feels welcome. And so building a culture where even though people have strong opinions about things, just like they do anywhere else, we're able to celebrate those differences. We're able to accept those differences. And so diversity also includes LGBTQ, includes people with disabilities, includes lots of different people who might not feel included fully in other cultures. We want to make sure they do. So we're proud of the awards, but we don't do it for the awards. We do it, again, just to build a strong organization, a strong culture. And then finally, under governance is where we put culture here, which includes things like these values that all of us have talked about forever. These are not new. These were the same values essentially when I joined 25 years ago. We go through global ethics training. We hold people accountable for ethical lapses. It doesn't mean they always get fired, but they get, we address it in a responsible way. And people do lose their jobs probably more often for that than anything else. So we're pretty strict about that. It also has to do with how we lead. So we are not a hierarchical company. We've worked really hard over the last few years to move from a hierarchical based model of decision-making to a distributed model of decision-making so that people all over the world can make the appropriate levels of decisions. And we think that's healthy for our culture and is a key part of governance. During COVID, for example, I would go to bed at night and wake up in the morning and discover a plant somewhere in the world had been closed because the local management team felt that something had happened overnight, daytime for them, and the right thing to do would be to close the plant. And I was so proud they did that. In previous years, people might have waited to see, what does senior management think about that? So all of that is key to ESG. And as you guys have said, it's become something investors are becoming more and more aware of, focusing on. There's now more metrics out there that everyone is aware of. In the early days, which by that I mean like 2 years ago, those metrics are pretty raw. And sometimes they would just look to see what was on the website, and you would get judged based on what was on your website. Some of those tools they used weren't actually able to read PDFs. They were only able to see things that existed in HTML format. So you might have had great information, but the computers just couldn't find it. So all of us have learned how to not just be better at ESG, but also to put our story forward in a way that's easier for investors to see and understand, and to gather the metrics and the data they're looking for, just like they would with financial information. Now we have to make that kind of information available as well. And then I think that's going to get even more interesting here as this becomes something that's required in filings for the SEC, as auditors are becoming more active in assessing the accuracy and completeness of that kind of disclosure. It'll be an interesting new frontier, I think, for companies and for investment analysts who are trying to make sense of it all. And I'll just stop there.
It was excellent, Jim. Thanks. I'm not going to try and add anything to that. So I'm just going to move forward to our fourth strategic pillar. In this one, we talk about accelerating our profitability and maintaining a conservative financial profile. So the second part of that has been an important part of Steelcase's structure. We are a cyclical business, so we think it's important for us to maintain a strong balance sheet, which is kind of the fourth sub-bullet. Capturing the benefits from pricing action. So most of our customers are large leading organizations. They have contracts of which we operate under. Typically, that includes some level of fixed pricing. Inflation has been such an extraordinary impact on our business over the last few years. We've never seen inflationary pressure like this. That's impacted our profitability in the short term. We've worked hard to negotiate new pricing with our customers, but it takes time for that to become effective with our customers. So where we've been absorbing costs for the last 6 quarters, We're now starting to see the benefits of some of those pricing negotiations, and hopefully, again, they should become a tailwind. We're talking about reallocated investments towards our strategic priorities. So this is making sure the most important things continue to get funded, and we need to pull back on certain things and become more fit in certain areas across the organization. And I decided to throw in just some recent news. I don't always do this in a presentation, but just in the last 2 weeks, we had our quarterly earnings announcement, and we had some fairly big news that we announced, and it ties into some of this profitability initiative. So if you looked at our headlines, you'd say, wow, revenue growth at 19%, driven by a strong backlog, including significant pricing benefits. Seems pretty good. We had strong organic growth across all of our segments. We did continue to see supply chain disruptions. That's been a factor impacting business for a while. And our inflation continues to be significant. We quantified that we've absorbed $270 million in inflation over the last 6 quarters. But for the first time, we finally started to see the pricing benefits exceed inflation on a year-over-year basis. So again, that's what we call a tailwind. So in one aspect, you'd say, wow, pretty good results, understand. At the same time, we announced additional reductions in our planned spending, and we lowered our quarterly dividend due to this uncertain demand environment. So in the second quarter, which is the quarter we just finished, we saw our volume actually go down on a year-over-year basis. And so we put plans in place to reduce our annualized spending by about $20 million, which is going to include the elimination of about 180 salaried positions. And then we had a fairly significant dividend reduction from 14.5 cents to 10 cents. Again, this is balancing the need to drive our strategic priorities with also having to maintain our short-term profitability. Just most investors ask about our capital allocation priorities. So reinvestment in the business is definitely something we always talk about, which can include acquisitions and has included more acquisitions over the last few years. Dividends are very important to Steelcase. You can see our quarterly dividend chart in the bottom left graph on this page. You can see we had pre-pandemic been advancing our dividend nicely. That was kind of consistent with our earnings progress. We had to cut the dividend initially pretty significantly during the pandemic. This is back, imagine when we were shut down and it was kind of an essential business only environment. So we didn't know how bad that was going to be. We were able to reopen fairly quickly. So we reestablished the dividend at a level of 10 cents. And then you can see as we got a little more comfortable with where we thought the pandemic was going to go, and we had a vaccine in place, so we thought it would become more possible for employees to return to work. We reestablished our dividend, you can see. And then again, it's not yet on the chart because it was just announced, but we will be reducing our dividend again back down to that 10-cent level. You can see it over time. Share repurchases is also something that we do from time to time. We actually repurchase a fairly significant amount of shares during the FY21 and FY22 time periods. Obviously, our stock has been volatile, and we think from time to time it's important for us to return equity to our return value to our shareholders through that method. And then the final slide that I just wanted to talk about was the balance sheet. Again, we typically have had a fairly conservative balance sheet. And just to help unpack, when we consider our liquidity profile, we have a combination of cash that's on hand. We have an asset called company-owned life insurance, which is a little bit different than what a lot of companies have, but we essentially have life insurance policies on some of our employees. We can access that in times of need to get the liquidity if we wanted to borrow against those policies. Otherwise, we can wait for them to mature and the company gets the benefit of that. And then we have access to a credit facility. And as we compare that to our debt to equity ratio, that's all part of our equation of trying to maintain a healthy balance sheet. It's been under a little bit more pressure recently because our EBITDA has been challenged over the last few quarters. So we've definitely been using some of our liquidity. Plus, we've made a couple acquisitions over the last year that were part of that liquidity math. So Jim, unless you have anything else, I was going to turn it over for questions.
Yeah, let's go to questions.
A problem finding the mute button there. Hello, gentlemen. Thank you so much. That was a great presentation. I learned a lot and took like 4 pages of notes. So here's what's going to happen. We're going to start with the listed teams in no particular order. While you're not speaking, please stay on mute so there's no background noise. I'll call on your team name. One person can be the spokesman and call out a question. We'll cycle through all the teams, of which we have 17 right now on the list. And then we'll come back around if we've got time. So have your questions ready. And team metallic gray, you can start with the first question. Please unmute yourself and ask your question.
Can you hear me?
Anybody? Yes, thank you. Go ahead.
Okay, mine has to do with the company-owned life insurance policy. How long would this allow the operating procedures to last if you had to use that?
Thank you.
Yeah, that's a good question. So right now, what we would have accessible, we could probably borrow, I think about 75% is about how much we could borrow of that balance, which is at about 162 million right now of cash surrender value. So call that a little over $100 million. You know, so if our EBITDA, you know, it always depends how far down you go and how much, you know, because we're not going to go to, it depends how low you would go, I guess. You know, we have a practice to try to not operate the company below what we would call break even operating income. As long as we're at break even operating income, we feel we'll have enough EBITDA to support a modest dividend, our CapEx, and pay our interest costs. So depending on how low the operating income got or the EBITDA would probably factor into how long the COLI could sustain us. Jim, do you have any other way that you've thought about that over the past?
No, that's true. And we also maintain a cushion of cash. So we have the cash plus the COLI available to us, plus other investment or debt options if we needed them. You know, the difference between operating income and EBITDA, as you guys know, is basically the depreciation and amortization versus capital expenditures. If we're at a point where we're at break even operating income, we're going to be pulling back on CapEx. So our CapEx will be less than our depreciation and amortization. And so we should be at positive cash flow, even if we're at break even operating income.
Okay, thanks for that. Let's move on to Team Salmon Orange.
Hi, we are Salmon Orange. So I have a question. Out of every factor that you guys thinking on, can you name top one headwinds and one tailwind that you guys facing right now? And what's your judgment for the next 5 years for the company?
Well, one headwind, you know, very recently is CEO confidence. The recessionary environment and the risk of that is definitely impacting, at least we believe it's impacting decision-making within corporations. We're still very busy. We're very active. We have a lot of customer visits. We have people asking for quotations, but we've seen a lull in the decision-making of converting that work into placing an order. And we believe CEO confidence is probably the headwind that we're feeling there. Tailwind, the one I might hope for is return to office. And it's been stalled. It's definitely not advanced like we thought it would. There's some promise that post Labor Day, we were going to see some resurgence. Again, this employer power of a lot of employees not quite yet ready to return to the office, but employers wanting them to. Given the first factor, the recessionary concerns, it actually may shift some of the power back to the employer, and maybe more employees will come back to the office. And if that happens, we think they'll see that they need to change their space. If they start using the space that they left, they'll realize they need to make some changes.
I'll add one other tailwind, which is, believe it or not, pricing and inflation. So for the last couple of years, as inflation spiked, we were facing challenges because, as Mike said, we have to pay those rising costs of steel and fabric and energy and everything else. We have to pay those costs right away, and yet we can't change our customer contracts on the selling side as quickly. However, as time goes by, we do change them, and as time goes by, they have to accept those price increases. And we've done quite a few in the last couple of years. Mike, I don't remember if you disclosed it publicly. You can, if you,
5 price increases, over 40%.
and you have the aggregate increase.
A little over 40% if we got all of it, which we never expect to get all of it, but that's what we've announced.
So imagine that all that's happened and it hasn't taken full effect yet because not every one of those contracts have rolled over. Meanwhile, prices are going to begin to stabilize, and normally prices would then fall back to traditional levels. Again, steel, energy, et cetera. As those things fall, traditionally those costs for us fall. And yet it's typical in our industry that we don't have to give back the price increases. So there is an opportunity for margin expansion in the future if what happens in the future is like what happened in the past. And that's a big deal because, you know, in normal times, we might be 35% gross margin, 22% operating expense, 13% operating income margin. 13% isn't much, you know, that's a thin enough margin. Let's call it 10. If we picked up another 5 points of margin because of those pricing actions I talked about, that would be a significant headwind. It would increase our operating income by 50%. So there's a lot of ifs in there, a lot of forward-looking statements in there, but
Yeah, and that just to make sure, that 13% would be an America's type of target potentially, or 10%,
Yeah.
like Jim said. Our European business doesn't return that yet.
thinner still, and so the irony of that is because it's a thinner margin again, anything we get from pricing, if we get 3 or 4 points from pricing, it would make a big difference.
Okay, let's move on to Team Black. Going once. Okay, next team, Team Navy Blue. Next team is Team Khaki. Okay, Team Royal Blue.
Hi, everybody. Thank you, Mike and Jim, for meeting with us today. I just want to say that we really appreciate it. It's a very unique experience that we get a firsthand approach at talking to some corporate executives or ex-corporate executive within the company. So I just wanted to say thank you. Our first question is, you talked about how innovation drives Steelcase, and you hit on a little bit of how there's a current shift between employer and employee power. We were just curious, how is Steelcase adjusting their targets as more and more employees are adopting this hybrid / work from home model, numerically or statistically?
Yeah, so maybe targets numerically. I'd say at this point, this has impacted our ability to have clarity with what I would call our long-term targets. We had established long-term financial targets pre-pandemic. We haven't been able to reconfirm those. They're still in our sights. There's still something that the company internally is, but the confidence level of when we'll return to those, we have not been able to reestablish. And one of the reasons, of course, is we're still trying to figure out exactly how that balance is going to shift out between staying at home, coming to work, and how corporations will adjust their real estate within the office. It's a great question for us to talk about with investors, and there's different theories about how much less space companies may take and potentially how much more investment they could make in the future. But because of the uncertainty, we haven't been able to reconfirm kind of long-term financial targets. Internally, what we're doing is shifting resources. Regardless of what happens in the office, we know that in maybe large cities, which is where we're seeing more of this kind of delay in returning to the office, we know there's growth opportunities either in our education business or in our mid-market business in smaller towns and smaller customers. So we're internally readjusting some of our investments to prioritize areas where there is growth in the shorter term, while we're continuing to invest for companies as they do try and solve hybrid and some of those challenges.
We also get some warning, which is, I mean, there's a good question about targets, because longer term targets will affect how much you decide to increase capacity in your factories and things like that. So you go, okay, well, what kind of early warning signs do we get? Mike mentioned those insights before. Those insights are things we share with customers when they come to visit us. Often they're coming to visit us 6 months to a year before a project where they're actually going to be ordering furniture. So we can kind of feel the winds shift from clients that are sort of passive, they don't have a project, but they're just sort of interested in research, towards, no, we actually have projects on the drawing board, they're getting funded. And so we get a pretty good read from that of when we need to be ready with capacity. So we're unlikely to get too surprised. There's also one other factor on the return to office. Normally, I'd say, recessions are bad news for us, like most companies. The recession could have an interesting impact, a counterintuitive impact on this factor. Already you're seeing articles show up about, as companies have announced potential headcount reductions, they're seeing more of their employees suddenly coming back into the office because you kind of want to be known. A lot of CEOs believe that as we go through a shift in the economy, we might see something like that happen where more people will choose to come back to the office. And so as a result, it could be that the recession could accelerate that that pivot back towards hybrid work or even primarily office-based work. So it's hard to predict from target setting, but it's an interesting counterintuitive factor.
Okay, let's move on. Team Maroon. Team Mint Green. We really had to dig deep in the box of the Crayolas here to get our colors.
I love the creativity.
Team Orange. Oh, I'm sorry. Is that Team Mint Green?
Yeah.
Okay, go right ahead.
Yeah. I just want to reiterate, thank you guys for being here, and I really enjoyed your presentation. So yeah, you guys talked about how your own furniture is your biggest competition in some ways. And you also talked about how a core aspect of investors' thesis is designing to evolve. So how are you guys doing that? And like, what other like revenue streams maybe can you guys utilize after you guys sell like a batch of equipment to an existing customer?
Yeah, good question. So an important revenue stream for our dealers is reconfiguration. So furniture that somebody bought 10 years ago might be in perfectly good shape, but it's in all the wrong places and it's being used in the wrong way. And so without buying new furniture, that client can reconfigure, and that provides service revenue for our dealers. And because dealers can make money off of the service revenue, it allows them to take a lower margin on the sale of furniture, and that helps us. So it's a nice ecosystem benefit. Some examples of things that we've been doing. So we realize is that the old cubicle farms of 20 years ago, where people had just put cubicles or worse yet benches from one wall to the other to try to see how many people they could squeeze into a footprint. There's a lot of spaces out there that are like that still, and we don't think those are going to be very attractive as you're trying to bring people back to the workplace. So we know that although we need to continue to offer furniture like that, the future of workstations will have to offer more privacy in place. So you have to be able to work at a workstation. Of course, there's still some economic realities about how big that workstation can be, but giving people more separation. We also know that COVID isn't gone. And so we actually did some research with MIT where we examined what happens when someone coughs in an office to see how far, as you cough, the particulates might go in the air, and design screens that were developed through iteration with the MIT people that we've now integrated into furniture that we're selling today. So some of the furniture that we're selling today is actually designed to give people more privacy, but also a little bit more sense of safety, that you can be in an office and you don't have to worry about getting sick if somebody in the next cube coughs. We're also putting a lot more effort into privacy. So one of the acquisitions we did recently is a private office company. We haven't done private office furniture investments in quite a while, but we think that private offices could become a big deal again for attorneys and investment analysts and others. And so we wanted to upgrade our furniture in that realm. So that was one of the acquisitions we did. And over the course of the last several years, we made acquisitions in companies like Orangebox and others that focus on collaboration in the office, because we think if people come into the office, it's not just to sit at a desk all day. You're coming in to collaborate. You're coming in for meetings. You're coming in to socialize before the meeting, after the meeting, make friends. And the kind of furniture people will need as they allocate more space for those purposes will be different. So we actually think that, I mean, Mike, you can update this, but our portfolio is in really good shape for the kind of work environment we can imagine that people will be moving towards. And we've been scaling back on investments in the kinds of things we think they probably already have too much of.
Yeah, sorry, I was just gonna say, like, do you think like with the current like environment, like you guys talked about like corporate profits after tax, like will companies maybe like shift to like cheaper options and less fancy options of furniture as well? Like, what do you guys think about that?
Yeah, they were doing that before too. And we were trying to address market that was broader than just large companies. So one of the acquisitions we made, maybe 4 or 5 years ago now, Mike, was AMQ. It's a California-based company that focuses on good quality furniture, but at lower price points than we sell. And they focus on speed. So the ability to order now and get product within 5 days. And we've seen growing demand for that product. And we've been able to re-engineer some of those products so that they meet the same kind of quality standards and increasingly sustainability standards that Steelcase has. So it's helped us broaden our range and increase our addressable market. Mike, do you want to add to that?
No, I think you're right. I think it was happening before, and Steelcase tried to step in to meet that gap. Sometimes it's just a particular product within the portfolio that they're looking for a more affordable solution. So by us being able to fill that one product need, we can still keep it as a full Steelcase customer because we have that in our portfolio. It's a good question about whether we're going to see continued pressure there. Inflation is something that people are asking me about. Our budget's growing, or our customers having to make trade-offs because the price per unit is going up because of inflation. And we're seeing a little bit of both. Sometimes they're scaling back their projects a little bit. Sometimes they're trading down with one particular part of the project. Maybe, the height adjustable desk they're buying, they decide to buy a little bit more of affordable height adjustable desk in some cases. So we're definitely seeing some pressure with the inflation and the fact that budgets aren't necessarily getting equally larger. But we do think we have solutions.
Okay, yeah,
Thanks, Mike. Thank you, Team Mint Green. How about Team Orange? Team Lilac? Team Saffron. How you like that one?
I don't know what it is, but I love it.
I think it's yellow.
Yeah.
Team Saffron, no. Team Purple. Any purple people? Team Red. Team Magenta. Team Green. This is normal green.
Hey. Oh.
Not mint green, but green.
I guess we were normal green. I didn't know.
Oh, okay, we'll skip you. We'll
Yeah.
come back around maybe. Okay. Team Yellow.
Yeah. So, firstly, I want to thank Mike and Jim for coming out here and just answering the questions. It's been a great experience. What we wanted to ask is, like, what is Steelcase's dividend strategy going forward in the future? So in the preliminary research that we did, we realized that the company's EPS has been falling for the last couple of years, and the payout ratio has been consistently increasing. So keeping such a high dividend when compared to the EPS or compared to the payout ratio, like, will it be sustainable, and how is the company looking going forward with uncertain environment? So what will be the dividend strategy going forward?
Yeah, it's a great question, and it's the right question for some investors for sure. So the company historically has supported a strong dividend. We know we have a couple shareholder bases that a strong dividend is important to. One of those is we do still have an element of the original families that own the company. And because they're typically not sellers, they're holders, they're long-term holders. The dividend is one way that we return value to a shareholder that's not looking to necessarily sell, which it's those investors would be more looking at the stock price going up and down. So that's part of the reason the dividend has been a very important part of the strategy. It's been fairly healthy. It's been, like you said, ahead of our earnings. Part of that is strategic in the way that we have conservatively had a balance sheet that would support sustaining a dividend even during the beginnings of a down cycle. And that's essentially what we were able to do was during this beginning time period of this down cycle, we've been able to still sustain a fairly healthy dividend, a dividend ahead of earnings. Now, we were comfortable doing that as long as we had good visibility into the future earnings. Most recently, that got a little bit more challenged as our volume level started to go down and as recessionary risk increased. At the same time, because we've been feeling the inflationary headwinds, our EBITDA has been lower, which obviously has hurt our liquidity level. So because of those reasons, the company decided to lower our dividend. Now, the dividend is something the board decides what to do with every quarter. So there's no specific way to know exactly what we're going to do moving forward. I think it's fair to assume that it will be based on the earnings outlook as far as our ability to I would call raise it. And to the extent that we got more concerned about the earnings outlook, it might have to be adjusted again. But that's about as much clarity as we can provide. We don't have the same liquidity that we had earlier in this, over the last 2 years. So it's more difficult for us to sustain it ahead of earnings like it was the last couple of years.
Thanks, man.
Thanks. Team Aqua, any questions today?
Yeah, so hi. First of all, thank you, Mike and Jim, for your time and effort in this meeting. I'm from Team Aqua. Basically, we are particularly interested in the business outlook for healthcare and government sectors in terms of your client base, because we, as a team, we think these two sectors will not be as much impacted by, either hybrid or work from home model. But we know your client base is pretty diversified, right? So it'd be nice to hear from you directly. Thank you.
Well, maybe I'll start, and Jim might have some more thoughts on this too. You're right. It is actually part of the reason we've increased our focus on something like the healthcare market, and we do have a fairly healthy government business also. And I think I would agree. I don't think either of those will be impacted by hybrid or work from home in the same way. Obviously, because of healthcare and the way that a lot of that service is administered, makes it some of that a little bit more difficult to do remotely. That being said, we're actually seeing advantages of some of that turning remote because the privacy needed to deliver telemed is an area that in the technology combination is something that we actually focus on and study. So actually delivering healthcare virtually is a growth opportunity for Steelcase in one way. But I agree, as far as the market goes, it's a little bit more insulated from the economy than some of the corporate environments. In government, I think I agree also culturally, that may not feel the same work from home hybrid strain that maybe the corporate environment would. I don't know about any other outlook on government though. Do you have any feelings, Jim, on that?
No, I would say that's right. And maybe I would just add education, because we often talk about healthcare and education at the same time.
Yep.
In the United States, education is mostly a state and local spend. And usually it's constrained by dollars, just, do people have enough money to invest? We know that the school infrastructure for K through 12 has been underinvested in for a long time. But in the last year, because of the stimulus money that has come from Washington to state governments, there is a enormous amount of money, more money at state levels than they can actually spend in a given year. And a lot of that now is being allocated by legislatures or by others to state and local schools systems. And a lot of that money will end up getting spent on things like furniture, building refurbishments, and so on. So we think that's another thing to keep an eye on.
Yeah, great add.
Okay, thank you. Let's just run through the people who had questions the first time around, just to see if there's any additional questions. Team Metallic Gray, anything else?
Yep, thank you. So you talked a lot about during the pandemic and situations that you've gone through during those times. What changes have you made during those times, and then following those times that affected your company with the inflation rates as well, that you think will be permanent now? So like, I guess what things have you changed since then that you plan to continue using?
Yeah, as far as the first part of your question, I'd say that the first thing we probably did obviously was research. We focused our research, and we like we frequently have, we believe we became very expert on leading topics that our customers were interested in. So we pivoted. Jim was obviously instrumental in some of those choices, but we definitely became known, and it's still being noted that we truly understand what it might take in order to have a more effective environment when it comes to working in a hybrid manner. The second part of that, which is an important follow-up, is we shifted our product development. We stopped some projects that we were doing, and we reallocated the resources and the priorities towards things that would address working more effectively in a hybrid world. Things like partnerships with Microsoft and Zoom and Logitech. We added investment to those ideas because we knew this idea of mixed presence was going to be a problem, meaning when everybody's virtual, like we are today, we're all equal. When everybody's in the room, we all have an ability to raise our hand and speak up. When some of us are in the room and some of us are virtual, those of us that are virtual actually are at a disadvantage because the room dominates and we kind of forget about the people on the screen. There's ways that you can lay out the environment that keeps the people on the screen as equally present in the room. And those are the types of things that we've been focused on with some of our research partners. So I would chalk those up as to the things we've changed. On the inflationary side,
I'll just add to that, Mike.
Yeah.
We also work closely with some of the leading suppliers of video conferencing technology to create environments that are actually designed so that their products work better in these environments and can be used in rooms where there might be 15 or 20 people seated. And there's some really interesting innovations coming out of that.
Yeah. And then I'm just going to shift the second part of your question. You asked about inflation, but I'm actually going to talk about supply chain. Because of the problems with supply chain, we've done a couple things. One of those is we've moved supply. We have moved supply from a long distance supply chain to a more local supply chain. I don't know that that's going to shift back. I think the agility that it provides in a more local supply chain is something that we're prioritizing and in liking. The part of that, another strategy to deal with that has been adding inventory. So we've increased our inventory levels as a buffer to the supply chain challenges. We don't want to keep that as a permanent solution. That's an expensive use of capital. And it's really there because of the disruption and the unreliability in the supply chain. I think we're looking for ways to remove as much of that as possible.
Thank you.
Team Salmon Orange.
I have one question. So you guys indicate that one of your strategic priorities is to drive growth in Europe and Asia. So what are your plan? Like, what is your competitive advantage when you go to the market in Europe and Asia, where it's like the market shares is a lot different from America?
You ready to go?
Yeah, absolutely.
Yeah, so Europe is I'll do Europe first. So Europe is an interesting market. Historically, Europe wasn't even Europe hardly. It was like there was the French market and there were French companies. And in Germany, there'd be German companies. In the UK, there'd be British companies. And every market was kind of a country and with their own local competitors. We were one of the few that competed across all of Europe. And yet, as we did initially, we were often trying to be like them too much. You know, we were trying to be British in Britain and trying to be French in France. And so in some ways, we were no better than anybody who was local. And finally, a few years back, we decided we were actually going to be globally integrated. So we're going to have the same brand, have our branding the same thing across Europe. We're going to have mostly the same products offered across Europe with some local tailoring and flavoring. We're, of course, going to have local relationships with customers, but we're going to leverage scale, and we've made those investments. And so that is actually now a pretty significant competitive advantage. We built a new headquarters for Europe in Munich, that isn't just the headquarters for Germany, but it's the headquarters for all of Europe. And by choosing to compete on scale, it allowed us to compete on a dimension that nobody else could really touch, because nobody else can get to that same size when they're operating at a country by country level. We think that's helped us gain sales, gain market share, and be more relevant to customers who are also doing the same thing. So more and more we're finding customers are no longer just in one country or another, but they're across Europe. In fact, they're around the world. They just happen to be maybe headquartered there, or they may have operations there. So we think we're more relevant. And it's okay that there's another segment of the market that is the local manufacturing company, probably selling to people they went to school with, who are a customer in that market. But we've made our choice and we're happy with that. Asia is a little different. You know, Asia is a new market for everybody, and every country in Asia it's got its own unique situation. We really have chosen there to compete again off the strength of our brand and quality. So and yet as we compete on quality, we also have to have price points that are relevant to the local markets. So we make sure, first of all, that our products never fall below a certain level of safety, what makes them safe and what makes them sustainable. We may make other choices around fit and finish and materials that we use to be able to reach locally relevant price points, but we always want to stand for quality and safety. And so that's helped us distinguish ourselves from what is a very competitive market in places like China and India. We also have local supply chains. So in China, the products we sell are mostly made in China or in Malaysia or in India, and the same is true in those other countries. So having locally relevant price points, having a locally relevant supply chain has helped us grow there. Mike, do you want to fix any of that?
No, I think the other, maybe just one other thing, we're seeing a lot of maturation of large Asian-based companies, which are global leaders in some ways. And we have found that they want a partner that has the same standards as they do. And so we talk about global business ethics, which isn't necessarily a given with some of the choices that they have. And we have found that our values line up with their values in a way that's not something that they necessarily take for granted or see with all of their choices that they could make as far as choosing a supplier. So as they've become more of a global corporation, they've wanted a partner that has the same values. And we see that as a differentiator. You muted, Deb.
I unclicked it. Thank you. Team Maroon, second question. Okay, I think I skipped. Did we do royal blue? We just did royal blue. So
No, you did not. We did not.
Okay, royal blue. Sorry, go ahead.
Thank you. So our second question pertains to your product mix. Specifically, we were curious as far as Steelcase, how you differentiate yourself from competitors for the home market specifically. So once again, we were touching on those soft points, but just, is it more of a stylistic thing? Is it material-based, price point? If you could just give us a little insight on that. Thank you.
Yeah, I would say, oh, sorry, Jim.
You go ahead.
Okay. Typically what I think you'll see the difference would be performance, which is probably something we would see in the office environment also, but it would probably also play out in the home environment. So we design our products, of course, to do something, to perform in some way. And that's true in the home office also. If you look at the ergonomics of our seating and our leading chairs that we sell into the home are our most ergonomic chairs. And we think that makes sense because that's why people come to the Steelcase brand, is for that level of performance. And so and whether it's a height adjustable desk or areas like that, I imagine that's where you're going to see the most differentiation of a Steelcase product when people are choosing things for their home office. I don't know that we've got another advantage that I would point out. We want to be easy to do business with. We want to make our products accessible. So we're available on Amazon, on Wayfair, on our own Steelcase site. So we, of course, want to be easily findable when you do a Google search on ergonomic office chairs. But why you would choose Steelcase over somebody else, I think it would typically be the performance.
And just building on that, so the irony is when people work from home, they spend more time sitting in a chair, at a particular chair, than they ever did before. So when you were in an office working, you would be in your chair for a while. You'd go to a meeting and sit in a different chair. You'd go visit a colleague. You'd go have lunch. you might only spend a couple hours in your actual chair. When you work from home, you're in that same chair all day long. It is the worst case scenario, actually. So there's no place where you need a better ergonomic chair than that. And then when you're done working, you're probably gaming. So like I am. So got my game console here. Gaming and working chairs are starting to blend together in the home. And although the marketing for gaming chairs is kind of hot and kind of design oriented, they're terrible ergonomic chairs for the most part. And so we're also making inroads on gaming.
Good point.
Brand new market. Let's move on to Team Green.
Yeah, so some of our team's preliminary research showed that the struggle of returning on invested capital like above the cost of capital. So like I think it'd be valuable if you guys provided some insight on that.
Yeah, so ROIC is an important metric, return on invested capital. At Steelcase, we actually pay some of our performance out based on that metric. You're very correct. It has been more of a challenge as the R side of that has gotten more difficult over the last few years. First with obviously our reduction in demand, and then more recently kind of the inflation and supply chain challenges. So we're focused on both. We're focused on maintaining the right amount of invested capital. That's gone up a bit, mostly through the working capital needs more recently, especially related to inventory. So we're working on bringing that back into a more appropriate level, I guess. And then the bigger part of that equation has been the return side. And so that's why profitability is one of our key 4 strategies right now.
I'll add that, if you go back before 5 years ago, ROIC was pretty good.
Yeah.
In established businesses like the Americas, it was really good. In some of these other markets, like in Europe, we were going through a bit of a turnaround phase. So that was trying to make investments to improve profitability, which has actually worked out nicely. In Asia, we were purposefully choosing to sacrifice profitability for growth. So when we would make a profit, we would immediately reinvest it in headcount and other ways to grow market share. But if you go back to what is the longer state of ROIC in a mature business, the Americas is probably the best test for that. Decisions we made 5 years ago was to start doing more acquisitions. We hadn't really done very many. Acquisitions are always going to pull your ROIC down a bit because you have to pay full value and probably pay a premium over full value. But the idea is that you're going to grow those businesses and they'll be strong ROIC performers in the long run. So there's a few factors that work there. I'd say that, as Mike said, there's a reason why we are paid on ROIC. We all think it's super important. Not me anymore, but them.
Okay, yeah, thank you.
Let's move on to Team Yellow.
Yeah, so I had the question about the input costs. So like in such an inflationary environment, the input costs are obviously going to rise. And as you mentioned, the company has good pricing power, so they can basically pass through the rising input costs. But if the prices of the products keep on rising, eventually the demand will fall. So what is the company's aim? Like, how is the company looking to maintain their margins going forward?
Yeah, it's a good question. So we always have had a healthy focus on cost reductions. So regardless of what's going on with input costs, our customers expect us to get more efficient over time. So that has not waned in the time period of dealing with higher input costs. Thus far, we've been fairly successful passing those input costs on because we're not unique as far as the way we design our products, the way we manufacture our products, the materials, the supply chain, negotiation power. So most of our peers are in very similar boat to us. So thus far, it's made sense, or we've all been successful at being able to implement pricing. Longer term changes around material choices, material content, design choices will definitely continue to play in, I think. So I would imagine if we got to the point where we were the material costs were not being valued anymore, we would be re-engineering the products in a way that we could properly balance the amount of value the customer is willing to pay for us at the margins. but those take longer. It takes longer to change materials in a product because it's a product that you sit in, work with, and so the things like safety need to be evaluated before we make material choices.
Last question, Team Aqua.
Thank you. My question, actually our question, relates to the advertising and marketing costs. One of the highlights of Steelcase's presentation was lead the hybrid work transformation. And that definitely means that a lot of your efforts would be towards research and development, developing new products, innovative products. So does that mean that in the near future and in the long term, you will expect a higher percentage of your revenue to be attributed towards, marketing or advertising costs?
Go ahead.
I mean, I don't know because I'm not CEO anymore, but I'll tell you, what I think we think about that in general is that our best, we have to do advertising and marketing, and we do. We use social media, we have trade shows, we have a number of things that we do to make sure that the people who are buyers of our product are aware of our product. We don't spend as much on consumer advertising. You could maybe criticize that and say maybe you should, because we don't do as much of that, and we probably don't get as much home office purchases as we would if we did that. But we don't want to go down that path of trying to chase consumer dollars, because we'd have to build a brand just for work from home. That's tougher than some of our competitors might face because they have more developed retail businesses. However, our advertising and marketing, our best advertising and marketing spend is when we can bring customers to our showrooms in Grand Rapids, Munich, and places like that. We build facilities in each of those places. We're constantly updating the furniture in those locations. We have teams of researchers and product experts and other people to meet those customers. We have 2 corporate jets that do nothing but fly customers in and out of places like that. Not for executives, by the way, it's really for customers. And that costs a lot of money. So, that's really advertising and marketing, the cost of us getting customers into Grand Rapids. But when we get a customer in Grand Rapids for a day or two, we have their complete attention. It's not a 30-second ad. We have them for a day and a half, and we get to know them, and they get to know us, and they get to see our products. So we know what they're struggling with. We know what they're sure they want to do. We know what they're not sure they want to do. They learn a lot. We learn a lot about their needs. We help them make better choices. We also learn a lot about what we need to be doing differently, product gaps we might have, capacity changes. So that's money well spent. I don't think that money has gone, I don't think the cost of all that has gone up, Mike, you can clarify it. I think it's been about what it's been. We learned during COVID how to do more of that virtually, but we really like the idea of being able to do that in person. We build deeper relationships with people that way. So that's been our primary marketing spend.
Yep, you're right. And we do deliver that at a local level. So New York City, Dallas, San Francisco, right, which is where a lot of our customers are near enough to that they
Hong
can.
Kong,
Hong Kong.
investments in other places, in China, in India, etc.
Okay,
Thank
great
you.
job, students. Really great questions. Very impressed with your work so far. So keep it up. A couple of things before we close. As all of you know, you will have one more opportunity to ask the company a question. I hope, Mike, that you know this too. We're going to have them aggregate. They're going to send all of their email questions to the CFA Chicago office. We will aggregate them. We will send you a single email. You can go through them and send back the answers, and we will distribute those. The email question will be due on Friday, December 9th. So please send those to the CFA office. That's the first thing. Second thing, teams, remember you have to be registered by October 21st. So you've got a couple of weeks from today. Also, faculty, if you could send your rosters to the CFA Chicago with student emails, it would be greatly appreciated. And we will also be contacting you all with the information for the upcoming valuation webinar with Jim Valentine. It's going to be held on November 4th, probably around this time of day, maybe a little earlier, it might be noon, but we will get that invitation to you out soon. So be ready with all your evaluation questions. Thank you to our company presenters, Mike and Jim. It was great to meet you virtually. You did an excellent job. So excited that you have agreed to be our featured company this year. We really appreciate it. Thank you again for your time today. And thank you all of the students and faculties for dialing in and participating. I thought it was a great call, some really great questions. Everybody's off to a great start. So good luck with your research. Let us know if we can be of any help and get to work.
All right. Thank you so much, gentlemen.
Thank you.
Yeah.
Thank you.
Appreciate it.